Thank you for joining in our webinar on the MENA Energy Investment Outlook, our flagship report in APICORP that we publish on an annual basis. Since last year, we started integrating or taking an energy transition approach in analyzing our outlook. So not only focusing on the oil, gas, and petrochemicals and power streams, but connecting these streams together in the light of the wider energy transition space. I'd like first to present myself and my colleague Suhail, senior energy specialists with APICORP. We develop this outlook on an annual basis. For any inquiries or questions, you can reach us through either corporate communications or emailing us directly. With this disclaimer, I would like also to add that the outlook is not a forecast. We do not forecast certain prices or quantitative directions of commodities or so. It is not an investment advice. It's not a securities related advice. This is trying to actually give an expert view of what's happening in the different energy sectors and subsectors, and connecting the projects on the ground with the emerging macro trends. So we do not aim to forecast anything with the outlook. We aim to highlight trends and give an expert view on opportunities, risks, challenges, and areas of development and improvement in the energy space. Okay, shall we start? Okay, starting with macro highlights. I'm sure everybody is following avidly what's happening on the macro environment on a daily basis now, and forecasts are revised from quarters down to months and down to weeks, and every week now we see sometimes frequent updates on a daily level on expectations of inflation forecasts, GDP forecasts, and pricing forecasts of commodities. The situation has been exacerbated by the Russia-Ukraine conflict. So the global inflation that started from 2020 through COVID and into 2021 has now entered the vicious cycle due to the effect and the spillovers of the Russia-Ukraine conflict. The problem is that stagflation risk is increasing since consecutive hikes in interest rates have done little to curb the soaring inflation across the world. The MENA region is no different. However, inside the MENA region, we see different or mixed bag. We see different effects. In North Africa, the implications of inflation are more announced due to the nature of the North African economies, highly dependent on crop imports, relatively larger populations, and with the exception of Algeria, they are net energy importers. For the GCC, the opposite is happening. The spillover, the windfall from oil and gas revenues is helping the GCC economies offset inflation, and also the population numbers are not putting pressures on food and FMCG generally. So we don't see inflation hitting hard in the GCC. It's in the low levels. In North Africa, it's on the high level. The Levant is in between. So you have also mixed bag. of everything. However, also the low populations in terms of numbers is helping not to put huge strain on food imports, especially crop imports that have been seeing a spike since the Ukraine-Russia conflict started. The GDP growth rates for the region remain optimistic and actually high for 2022. There are downward risks for 2023, and it will depend on how the North Africa and Levant economies manage inflation, manage their public financing and deficits. This will be a big role. This will play a big role into moving into 2023. Okay, moving to the energy investments. Our energy investment outlook 5-year going forward, so from 2022 to 2026, capture a 9% year-on-year increase from our previous outlook in 2021, and totaling about 879 billion. The good thing is that committed investments remain at a healthy level. Committed investments are actually a litmus test of how much, how many projects are into execution mode. If you see projects into execution mode decreasing on a year-on-year level, this shows a retrenchment or a retraction, a contraction in the energy investments or energy expenditure. However, when you see execution, projects in execution in a steady level or increasing, it is a good testament that energy investments are going steady. So breaking this down, we see that oil investments make up about 1/3 of the total committed projects. And this is due to the fact that oil capacity buildup is prioritized. The gas investments follow with about 30%, and they are back to pre-pandemic levels in the MENA region. This is mainly driven by gas-to-power projects and the gas export projects in the region. The power sector renaissance, as we like to call it, continues. It started in 2018, and it maintains its drive. We see that the power sector investments actually continue on the same level of 2021. And this includes renewables, grid modernization, and most remarkably, since 2021, the investment in interconnection projects, the interconnectors between GCC and Iraq, Egypt and Saudi Arabia, and also in North Africa between Egypt and Sudan, Egypt and Libya, and so on. There's also one notable planned project which is exporting or linking the region, the MENA region, with Europe via a subsea cable through Cyprus from Egypt. It's an MOU has been signed, and it very well may come to fruition given the power crisis in Europe. Petrochemical investments, in contrast, remain in a tentative mode. We see only that 9% of petrochemical projects are in execution. Most of these projects are projects that have started their execution phase before the COVID crisis, so pre-2020. However, a lot of projects are still waiting FIDs as the sector repositions itself based on the rapidly evolving industry globally. Again, the Russia-Ukraine conflict has driven the petrochemical players to go back to their feasibility studies and economic and commercial studies as the industry tries to reposition itself with the disruption of the WTO model that has been happening since the COVID crisis and 2020, the year 2020. and which is more announced now with the crisis in Eurasia. One thing to note also here is that looking at the planned investments, we see the high potential of petrochemical projects in the planned phase, and it shows that the region has the projects in place. However, the decision will be taken as I mentioned, as the sector repositions itself. Moving on. For natural gas, it is notable that natural gas is underscored now, given energy transition goals and also the desire of balancing oil and gas exports from the region. So oil capacity is the investments in oil capacity in increments led by Saudi Arabia, by the UAE, by now Kuwait and Iraq. We see that also in gas, capacity increments, substantial capacity increments are being executed, notably in Qatar, with the largest mega project, the North Field expansion. This year, the North Field South, which is the second phase, also start coming in the horizon of our outlook, because the North Field East, which is NFE, is supposed to be online by 2026. However, in 2026, Qatar will start working on the North Field South expansion project, driving the total capacity of LNG exports to 126 million tons per annum. So this is a boost to the gas investments. And here you can see the chart on the left showing us that oil and gas projects, committed projects, are almost 49 and so almost 50% of the total projects in the region. With power, the type of projects is changing. So investments in renewable continue, investments in decarbonization continue. My colleague Suhail will take you into great detail of into the power sector and renewables and hydrogen. And there is an authentic analysis that he did on the hydrogen economics of the region that he will present later. As mentioned, the chemicals sector is the lowest in terms of committed projects, with lots of planned projects in pre-FID stage. Okay, going to country analysis. As per the usual trend, Saudi Arabia, the largest economy in the region, leads the flock. Investments are into oil, into gas, but notably into power sector. The Saudi renewables targets and renewables projects are sizable. And again, my colleague Suhail will take a deeper look into the power sector. Saudi is followed by Iraq, as Iraq remarkably recovered from the COVID malaise. The economy returned back to health, and the country is actually racing time to progress with its infrastructure development, notably in power sector, gas to power projects, but also renewables. Their main challenge, however, is ramping up oil production capacity. And recently, the Iraqi minister stated that a realistic expansion target in terms of oil production capacity would be 1 million barrels instead of the 2 million barrels that were previously planned and stated in 2021. Iran also is ramping up its investments. However, with the setbacks of the nuclear talks, a large portion of these investments is at risk and highly unlikely. Egypt follows with, here you see a considerable portion in petrochemicals investments. The drive in Egypt for petrochemicals is not exports, but it's actually import substitution and spurring further industrialization and job creation. The COVID crisis, one of the lessons learned from COVID crisis was actually that disruption in global supply chains can damage industrial economies that depend on raw materials from abroad. For a country like Egypt with a huge population and very ambitious job creation targets on a yearly basis, this can be very problematic on a socio-economic level. And this is why petrochemicals constitute a large portion of the projects in Egypt. There is a continuity also of the power sector development from previous years. As mentioned, due to the interconnector projects, there's also a continuity of or a resurgence of gas, especially offshore licenses being granted in the Mediterranean to feed into the LNG export hub, to also in light with the latest agreement with Europe. And then comes the UAE. The UAE was the first country in the region to commit to a net zero target by 2050. The UAE is a leader also in nuclear power generation, with its third reactor now online. They have a surplus of gas. And this surplus of gas is actually opening up opportunities for LNG exports. The UAE is planning on constructing an LNG export terminal on the Indian Ocean, so straddling the Strait of Hormuz, where there is high geopolitical risk. So this project will be a great differentiation in the LNG export from the region. Following through with the rest of the countries, very quickly, Oman tries to extend its oil and gas production plateaus, more investments into hydrogen, which Suhail will talk us through in a while. Qatar, gas dominance, as you could see with the green bar. Algeria is also trying to revamp its oil and gas capacities. However, notable reforms have been taken in terms of structural reforms, in terms of creating a new authority for renewables to oversee the renewables development, and the country has a huge renewables potential. They are also studying exporting hydrogen, and they can be a major hydrogen exporter, as will be overseen in a while. In Kuwait, again, it's mixed bag, and the rest of the countries, as you could see, nothing notable. So the expected mix: Morocco, mostly power. Jordan has some oil shale planned projects that can also be remarkable under the current oil price environment. If it sustains to the next years, it can be commercial. The Libyan oil sector is still suffering from the spillovers from the political standstill. However, a previous study in 2021 that we conducted in APICORP showed that Libya can have an annual investment in oil and gas sector of around $50 to $60 billion. So Libya has a strong potential. if things go back on track. Going to the government and private sector view, usually the net energy importers had higher participation of private sector in the energy investments, with the exception of Oman. But now we also see a private sector involvement increasing in Iraq, which is notable. For the GCC countries, and despite all the diversification efforts which are yielding fruition, the size of the market and the energy investments actually dwarfs any growth in private sector. This doesn't mean that the private sector is not growing in the GCC, it is growing, but the size of the public investments is so huge that it outpaces any growth in private investments. For net energy importers, the private sector takes the lion's share, particularly in Jordan, Lebanon, and Morocco. Okay, one theme that we started covering from last year is the sustainable and green finance. In 2021, the amount of the magnitude of green and sustainable finance that the region registered more than tripled. And this is a testament of how seriously the region is embarking on energy transition. It shows also that the projects have been de-risked to a great extent, with increased participation not only from MDBs, as was the case when renewables and clean energy started. Now commercial banks participate, private companies participate, conglomerates, from small projects that involve energy efficiency or solar PV in parking lots or over the headquarters of buildings, to actually supply chain optimizations and to more than this. The region is fast-tracking sustainability projects driven by the net zero targets, and also driven by the very lucrative export markets. So the region envisions that it can be a huge player in a post-energy transition world, or in an energy transitioning world, just as it was in the hydrocarbons era. The energy has a huge potential in renewables, and with the fuels that can be extracted from renewables, like hydrogen, which will be represented in great detail, the region has and plans to be a major player. The sovereign wealth funds are also driving now and stepping into the sustainability and green investments, with especially notable investments in hydrogen projects. Every day we see projects and MOUs signed in not only in the GCC, but also outside the GCC, in North Africa and in the Levant, for hydrogen, for renewable projects. However, 2022 may not be record-breaking, just like 2021 was, due to the current energy crisis effects. This year will be a crossroads globally and for the region. So as people say, the train has left the station. Yes, the train has left the station, but the pace that the train will take, or if it will go into a momentary pause or a momentary slowdown before it catches up to speed again, is the thing we're talking about here. This is the question. All eyes are on the next COP27 meeting taking place in Sharm el-Sheikh, Egypt. Of course, the energy crisis is the dominant talk. However, how the energy crisis has derailed or has compromised the pledges taken in COP26. This will be discussed. What is the way forward? And also, we hope that there will be lessons learned from what happened in the last 2 years. The expedited divestment of hydrocarbon assets by IOCs and listed companies due to public pressure actually created a negative effect, because you had these assets transferred to private companies off the radar, some of them, or the majority of them, non-listed. And this actually is not good for ESG perspective. You have less visibility, you have less prudent management of operations of these oil and gas assets by nature, because when you are not a listed company, when you are not a company that the public has a stake in, you generally tend to have less scrutiny in your reporting standards and in your operational controls, especially on ESG level. The other lesson learned is to take ESG in a balanced format. We hope that focus will be equally balanced between the E and the S and the G, and not only on the climate factor. Even the climate factor is part of the E dimension. And in this regard, I'd like to mention that one notable, very notable accomplishment has been the plastics treaty, the UN endorsed plastics treaty that was ratified in March this year, and which is planned to go into effect in 2024. It covers the full life cycle of plastics from production to recycling and achieving circularity from the plastics and polymers operations. So again, coming back to COP, the region hosts COP27 in Egypt and hosts COP28 in the UAE next year. So the region will be will be under the spotlight, and it will also feed into the global conversation on energy transition. Following the same line of energy transition, this is just a snapshot to show that, contrary to the public belief, that the MENA region has not been doing much to boost energy security. Looking at what happened since the COVID crisis in 2020, with global upstream investments falling from 500-something billion to 350-something billion, we could see that actually the MENA region increased its share of global investments. So going from 15% to 20% in the year of peak COVID spread. The trend went even further in 2021 as global economies suffered from piling public debts and economic turmoil. The region also increased, the region continued to increase its investments in upstream, which is basically boosting oil and gas production capacities. The MENA share of global investments rose to 21%. In 2022, there are divergent views on how the global investments and the global spend in upstream will recover. However, if we take a figure of 494 as an average between different outlooks from different institutions, we could see that projects on the ground that will be implemented in the region comprise around $90 billion, which is 18+% of the global expenditure in upstream, still above pre-pandemic levels, still above pre-crisis levels. So these numbers, again, refute the idea or the notion that the MENA region is not doing enough to contribute to energy security. The expansion targets, the expansion projects that are happening in the region, either in oil or gas, do not have an immediate effect. However, this is one thing to note. LNG projects have a typical 4 to 5 years lead time. And this is where we see that, and it's not a secret, that the prices will not ease in the medium term. So even with some projects coming online from other parts of the world, West Africa, the US, maybe in Australia or Latin America, Canada, but still it's the major chunk of additional capacity is coming from Qatar in 2026. Even if expedited, it will come in 2025 at best case. The UAE LNG project, 10 million tons per annum approximately, again, not before 2025. There has been rumors about expansions in Egyptian LNG trains. Again, there will be rational expansions because the capacity of the trains will not allow for like doubling the capacity. So it will be increment, marginal increment. So we expect that the prices of oil and gas will continue to at an elevated level into 2023. There is nothing that helps cool off the prices in terms of fundamentals. So from additional capacities, substantial additional capacity in the medium term. So looking at the chart on the right side, it shows the huge divergence between the forecasts of LNG spot prices from last year and what actually happened. So this triangle, this pyramid, is what actually happened, and the bars are the forecasts from previous years. The lowest divergence has been with Henry Hub because the US was able to ramp up its gas production very quickly thanks to the shale gas and shale oil associated gas. However, in Europe and Asia, the prices spiked to these levels that you could see for 2022. For 2023, it will continue to be high. However, the forecasts are tapering from the peak a little bit because the market is intelligently balancing or trying to balance or rationalize its gas, and also thanks to the flexibility of some of the exporters in waiving the destination clauses that constrain cargoes to a certain place or a certain location. The other lesson or the other note that we could take from this ongoing gas market snapshot is that the term contracts are at an advantage. Looking at the chart on the left, we could see that the spot and short-term LNG trade has been rising almost steadily in the last 5 years. This is good in terms of commoditization of gas in form of LNG. However, it exposes buyer and seller to volatility in prices. So while the global market was moving away from long-term contracts, the long-term contracts proved that a volatility or harsh volatility can be avoided through such term contracts. Looking at the green dotted line, this is the performance of the Asian term contracts, the average of the Asian term contracts during 2021 and 2022, where the gas price overshoot to an equivalent of almost $350 Brent. For 2022, jumping back to the left chart, for 2022, the amount or the percentage of spot or short-term LNG is going to be substantial. It will definitely be around double of that of last year, because what happened with last year is that some of the contracts globally and particularly in the region had expired, and the off-takers elected not to renew these contracts in light of the uncertainty around the future of gas. And again, this is one of the lessons learned in regards to COP and energy transition. The hesitance to brand or to term gas as either a transition fuel or a low carbon fuel, this hesitance and delay resulted in some remarkable FIDs being postponed, some gas capacity and LNG capacity increases cancelled or postponed, and contributed to this shortage and tightness of the market, and hence the spike in prices that we are witnessing and which will continue into next year. There has also been a more dire effect, which is actually reverse fuel switching. So switching back to coal, which was actually the key note on COP26 closure, that coal usage should be phased down. And they only used the word phased down because the initial term was phased out. So now seeing that not only Asia is reverse switching to coal, but also Europe, unfortunately, given the Russian gas cut, this compromises the climate targets on the short and medium term. I will leave now the floor to Suhail. I know I talked a lot. Suhail will give you the in-depth overview on power and renewables and hydrogen. Thank you.
Thank you, Rami. Before I proceed with my slide, I just want to remind everyone, if you have any questions, please feel free to ask your question on the Q&A feature in Zoom. Starting off with this slide, basically in every energy investment outlook, I like to start the power section with an overview of what's happening on the power demand and the power supply mix in the MENA region. Especially during 2020 and the COVID pandemic, we saw that the power demand in the region dropped. However, it dropped less than the global slump in power demand, and that was remarkable. In 2021, as the economy started to rebound, we saw a recovery in the power demand in MENA, which reached around 3% in 2021. In 2022, we expect this increase to reach around 3.5%, with an average of a 2% increase from 2023 onwards. What is remarkable when we are tracking the power demand profile in MENA is how the split in the anchored loads is changing within the economy. In 2020, as people spent more time at home, the residential power demand reached around 40 to 41% of the total power consumption in MENA on average. With economies rebounding starting 2021, we saw that the residential power demand dropped to 34%, giving way to the commercial and the industrial sectors. Together, the C&I sector now composes around 44% of the total power consumption. Basically, the residential, commercial, and the industrial sectors on total, they constitute around 78 to 80% of the power consumption across the MENA region. And the next slide, if you may, Rami. Next slide, please. Yeah. One new thing that we did in the power section this year is to see what is the level of electrification in the MENA region. As you know, with the ambitious renewable energy targets in MENA and the net zero targets by 2050, electrification and electrifying economies will be a key tool to reach that net zero target, especially if the electrification is coming from low carbon and zero carbon energy sources. What we saw here is that with the increase in power demand by 2025, we see that the level of electrification measured as a kilowatt hour per capita per annum, there is a lot of disparity between different MENA regions, between the GCC, North Africa, and the Levant region. We see that based on this analysis, Saudi Arabia and the UAE have the highest kilowatt hour per capita per annum, which means that they are most electrified, while other countries in the North African region or Levant region have lower level of electrification. On average, if you are looking at the MENA region and comparing it with the developed regions in the world, basically the region has to triple its electrification level to reach that level of the developed nations. This translates into a pipeline of projects in the power sector, specifically in renewables. Of course, to reach that, you need efficiency in policies, efficiency in regulations and laws, encouraging private investments, decentralizing the power sector, unbundling the power markets in the region, having a spot market for power maybe, enhanced digitalization, and of course, decarbonizing the grids, especially that most investments, they flow to the generation side of the power value chain. Around 85% of the investments that we track usually flow to the generation side, with only 15 to 12% going to the transmission and the distribution parts of the value chain. However, these are very essential to reinforce the grid, especially when we are adding intermittent renewables to the power grids. You need to have flexible, reliable, and reinforced the transmission and distribution networks. And the next slide, looking at the power demand, now we are looking at the power supply and how is the power supply mix changing by primary fuel in the MENA region. We usually select few countries and see how year on year the power mix in these countries is shifting. The main trend that we are noticing is that natural gas and renewables, mainly led by solar PV, are gaining more shares in the power generation mix at the expense of oil-fired and coal-fired power plants. We expect that by 2024, natural gas on average will be constituting around 70 to 75% of the power mix in MENA on average, 20% for oil, and 4 to 5% for renewables, and the rest for nuclear, led by the UAE and hopefully Egypt in the coming years. And also we have still heavily dependent on coal, which is Morocco, but they are doing a great job in decommissioning and replacing those with the renewable energy sources. Of course, there are very ambitious renewable energy targets in the region, and to achieve those targets, renewables will be added more and more. However, the intermittency issue with renewables impacts the fact that fossil fuel and nuclear power generation will remain indispensable in the power grids for the medium to the longer term. However, we see a shift in the power mix in several countries. For example, in Saudi Arabia, the natural gas share is increasing at the expense of oil. In the UAE, actually, natural gas is giving way to nuclear and solar PV. Egypt also, natural gas is relatively stable at the same level, with more capacities when it comes to renewables, solar and wind. Coal is doing a great job, as I said, by replacing coal with renewable energy sources. And the next slide, the renewables additions in MENA, as I was saying, we added around 5.6 gigawatts of renewables in 2021. And throughout our analysis, which again, I repeat, it is based on a project-based approach. That is, it is a bottom-up approach. So we track what are the committed and the planned projects. We see that around 33 gigawatts of renewables are to be added in MENA for the upcoming 5 years. Now, the important fact here is that around 80% of that number are led by solar PV. So 26 gigawatts for the upcoming 5 years will be added by solar PV. Also, within the solar PV markets, around 58% will be dedicated to utility scale PV, 20% for distributed PV, which we see that this 20% will be increasing as more decentralization is happening in the power grids, 20% for wind, and the rest for other renewable sources such as CSP, geothermal, and hydropower. Of course, several countries in the region are doing great strides, big steps to achieve their renewable energy targets. Morocco and Jordan have already achieved their short-term targets, and they actually expanded upon and put very ambitious mid-term targets by 2025 and 2030. Other countries, especially in the GCC and Egypt in North Africa, so Saudi Arabia, UAE, and Egypt, they have very ambitious renewable energy targets. And although the current installed capacities of renewables is relatively modest, but the pipeline of projects committed and planned is remarkable. And it says that if all these projects go through, hopefully they will be able to achieve their at least medium-term and short-term renewables targets. And the next slide, here I will start talking about hydrogen. I know hydrogen is a topic that has been gaining a lot of momentum in the region and globally. So we thought that for this year, we do a comprehensive section on hydrogen, basically expand upon the section that we did last year. So here we try to summarize the different types of hydrogen. You hear a lot of hydrogen colors in the news: green, blue, pink, yellow. So we wanted to clarify that for those that are a bit far from the hydrogen landscape, and basically explain that there are, based on the production methodology, there are basically two categories for producing hydrogen, either through electricity or through fossil fuels. Basically, the ones produced via electricity is through electrolysis, and the source of electricity determines the carbon footprint, what is the color of that hydrogen molecule, etc. As for the other hydrogen molecules, which are produced from fossil fuels, such as coal or natural gas, of course, this also differs from where the feedstock is sourced and what is the carbon footprint for that hydrogen molecule. In the region, in the MENA region, basically green hydrogen and blue hydrogen will dominate the hydrogen markets here. Basically, green hydrogen is simply splitting the water molecule into a hydrogen molecule and oxygen through electrolysis. The source of electricity, which is powering the electrolysis process, if it is coming from a renewable energy source, such as solar, wind, hydropower, geothermal, it is termed as green hydrogen. For blue hydrogen, which is very much prospective in the region, this is produced from, most notably, natural gas by reforming the CH4, the methane molecule, and basically splitting the carbon molecule from the hydrogen molecule. However, this process usually ends with a CO2 emission. If the CO2 emission is kept and it is distributed into the environment, it is termed as gray hydrogen. Blue hydrogen, you have another technology which is capturing, utilizing, storing, or reusing this carbon dioxide through a CCUS technology. That's why you see that the footprint for blue hydrogen is usually low. Now, based on these two color spectrums of hydrogen, we see that the hydrogen markets currently 95 to 98% are gray hydrogen, with very small percentages for blue and green hydrogen. The current size of the global market is 90 million tons per annum, with the region, the MENA region, basically consuming around 8 to 9 tons per annum of hydrogen, especially in the petrochemicals, refining, production of methanol, ethanol, and fertilizers. We see that the hydrogen markets are going to expand considerably and to reach around 300 million tons per annum by 2050. Based on the strategies and the policies and all the projects that we are hearing currently, we believe that basically several production hubs could emerge in MENA, especially in the GCC and North Africa, which should cater for at least 10 to 20% of the global hydrogen market by 2050. And the next slide. In the next slide here, we wanted also to explain what are the different applications where hydrogen could be used. As I said, we see that hydrogen technically fits the energy-intensive industries and the hard-to-abate sectors. What do I mean by the hard-to-abate sectors? Meaning that the sectors that you cannot electrify, you cannot replace the molecule that you are burning to generate that amount of heat with electricity. So you're still gonna need a certain type of molecule to generate that very high level of heat. And usually that is typical in petrochemicals, refining, in the cement industry, aluminum, steel, so which already use the gray hydrogen molecule, the carbon emitting hydrogen molecule, if you may. Therefore, what we are doing is that replacing basically the dirty molecule, the dirty hydrogen molecule with a cleaner molecule, either blue or green. So these are the de facto applications that we see. Other prospective applications could be the long distance transportation, maritime shipping. We do not see that hydrogen could be as efficient as conventional fuel for short-term transportation, for example, or residential heating. So here, whenever you hear that hydrogen could be the holy grail of the energy vectors and it could replace every possible energy vector out there, this is not very accurate. Hydrogen is much more efficient in the energy-intensive, hard-to-abate industries. Other applications, there are other energy vectors which could be much more efficient. And the reason behind that is hydrogen carries an energy content which is very high, but on a mass basis. On a volumetric basis, it has less energy content than fossil fuels, for example. In the next slide, here, what is the vision that we see for the hydrogen markets emerging in MENA in the short term, medium term, and the long term? In the short term, of course, we see that the green and the blue hydrogen markets are relatively small. And the reason behind that is the technologies and the markets need to scale up. When we talk about green hydrogen, basically renewables have to scale up. We need to see more projects in a multi-gigawatt scale. And when also the electrolyzer technology has to scale up, now we have modules of electrolyzers and multi-megawatt capacities. However, we need to see multi-gigawatt sized electrolyzers in order to reach the scalability that we want in green hydrogen. As for blue hydrogen, here the technology that needs to scale and to be de-risked is basically the CCUS technology, which is carbon capture, utilization, and storage. So in the short term, we believe that the market is still structuring itself. We will be laying the market foundations. And what I mean by that is scaling up demand that will justify a business case to go through with the planned projects and create supply hubs. Because right now, domestic demand for hydrogen in MENA is negligible. And if there will be an export market, if there will be a market in the medium term, it will be for export markets. Of course, in the GCC, we see that blue hydrogen will be focused on. And the reason behind that is most projects are being driven by the NOCs in the region, whether Saudi Aramco or ADNOC in the GCC in both countries. And basically, the blue hydrogen production methodology slightly disrupts their business model. Basically, the natural gas which is being used, they can just add a different technology to it, capture the carbon dioxide, and you get the hydrogen molecule. And they are already producing hydrogen molecule, as I said, for the petrochemicals and the refining industry. And the much longer term, by 2030, 2035, we believe that more and more supply hubs will emerge as the market gains clarity. Green hydrogen, as scalability reaches a certain size, we will see that costs will start to decline. And it will reach a point where we will have parity with the green and gray hydrogen molecules. And of course, a big driver for that is the flow of the private investments. And the more the markets, the hydrogen markets are de-risked, especially technologically, from a regulatory and policy perspective, from a market perspective. Here we'll see more and more confidence from the private investor to invest in the hydrogen markets. In the much longer term, of course, green and blue hydrogen will be widely adopted at the expense of gray hydrogen. The market will expand. Hydrogen at some point will transform into a global tradable commodity, such as LNG right now. And we believe that governments have to play a role in incentivizing and creating domestic demand for hydrogen so that the produced hydrogen could be used domestically and exported to outside markets. In the next slide, here we did a total final cost analysis of how the two most prospective supply hubs for hydrogen could compare to each other with respect to demand markets. Basically, we see that the GCC and North Africa could emerge as hydrogen export hubs in the future. And the demand sinks that are very clear right now are Southeast Asia, most probably Japan and South Korea, and Northwest Europe. Here we compare the total final cost, that is the production of hydrogen, the conversion of hydrogen, the storage, and the transportation. So it is not an LCOE analysis, it is an LCOE plus the value chain costs. So the hydrogen molecule reaches the end user at the final endpoint. And we did that analysis at the level of both types of hydrogen, which are most probably the dominant, the green and the blue hydrogen. Basically, what we found out here is that GCC will be well positioned to export blue hydrogen via ammonia shipments to Southeast Asia, which Saudi Aramco, ADNOC are already doing that by sending test shipments. We see North Africa emerging as a green hydrogen export hub, especially to Northwest Europe, and especially that North Africa has a very high competitiveness and competitive advantage when it comes to connecting to Europe via a network of hydrogen pipelines, or even via liquefied hydrogen, because liquefied hydrogen could be a solution, but for short distances. At long distances, which exceeds 1,000 kilometers, usually ammonia shipments becomes much more efficient. So this concludes my slides. Back to you, Rami, if we have any questions.
Indeed, Suhail, and thank you for the handover. We have two interesting questions actually on power. So I would like to keep the momentum with what you were mentioning. So one question is, what effect do you see in the Moroccan power mix in light of the cuts in gas supplies?
You mean from Algeria?
Yes.
Due to the latest spat with Algeria?
Yeah.
Well, I believe that Morocco has put ambitious renewable energy targets. I mean, the strategic objective of the Moroccan energy policy, I believe, is that to reduce dependency as much as possible on fossil fuels and importing fossil fuels, and basically depending on its natural resources and renewables. However, as I said, it will always need natural gas. What Morocco is doing is that it is exploring with Spain the possibility of importing again LNG imports, and I think recently they awarded an FSRU offshore Morocco to import LNG to cater for that missed shipments. That's one. Second, Morocco is being very active on its offshore exploration, and I think they found a prospect reservoir that is relatively small. Maybe Rami, you can expand on that, but they are also active on that. So I believe that Morocco is trying to act upon both its energy transition journey and reaching those renewable energy targets, but at the same time, making sure that energy security still remains a priority. And it is trying to do that by reducing dependency on exports, basically, and leveraging its natural resources when it comes to renewables and natural gas, whether through offshore discoveries or else.
Yeah, indeed, they are expediting their offshore, their production from new discoveries. The second question, what are plans for energy storage projects across the region?
This is an interesting question because we published in December of last year a policy paper, a white paper on energy storage and MENA and how much prospectivity there is on having energy storage projects in the region. The energy storage markets are gaining momentum. There are around 30 energy storage projects in the region between planned and committed. The region has one of the biggest energy storage projects in the Red Sea development project. I believe it's 1 gigawatt hour, lithium-ion battery based, totally off-grid, which is a huge project. Of course, energy storage will play a very critical role in scaling up renewables, as I said, because the more you add renewables and intermittent energy sources, instead of curtailing that extra power that you can extract from the sun or the wind, basically you are storing it and reusing it. So it enhances and makes the business case basically much more attractive when it comes to the project. So energy storage basically adds flexibility to the power grids, adds reliability, makes sure that power is never interrupted. However, the issue with energy storage is the timing of storage. Till now, the technology that we have can store energy for up 8 to 10 hours maximum. They are a bit costly. They need a lot of critical metals and minerals, which are sourced from strategic locations globally. So that's another pressure on the supply chains. And looking at the life cycle impact of extracting lithium, of extracting cobalt or copper, it might not be as environmentally friendly as we see it. But I believe that energy storage is a critical missing piece of the puzzle, I would say, to reach our net zero targets and to be on path towards energy transition.
Okay, last question also to you, Sohail, because you handle all the hot topics. Is there a concern that by 2030 onwards, green hydrogen production in Europe will be more cost effective than the one produced and shipped from the MENA region?
Green hydrogen.
So I perceive that the question relates to hydrogen production from wind, for example.
Yeah, I mean, the issue with green hydrogen, if you are sourcing your electricity feedstock from solar or wind, the issue in Europe is the land area, basically. So if you want a scalable green hydrogen market and multiples of million tons per annum of hydrogen production, you need huge amounts of land dedicated specifically for solar panels or wind turbines. And plus, wind turbines have to be away from inhabited locations, away from city centers. So that would pose a challenge in Europe, which the region in North Africa and the GCC, they do not have. We have a lot of land, unused land. And the land that we have, which is unused, has a lot of prospectivity when it comes to very high wind speeds, for example, in Northwest, the Arabian Peninsula, on the Red Sea, and the highest level of solar irradiations globally exceeding 2,500 kilowatt hour per square meter. So we have the natural resource, we have the land, we have the lowest costs globally. So I believe it will be a bit challenging at scale. So in Europe, you could see a domestic hydrogen market evolving because they are now the niche market for research and development when it comes to electrolyzers, which is the essential component of producing hydrogen. But I would say that the amounts which will be produced from Europe will not be to scale of exporting, for example, as the GCC or North African regions can do.
If I may add, Sohail, also the market size at this moment will be so huge that it will just be like the natural or LNG market, for example. You have multiple players from all over the world to actually cater for the demand.
Absolutely, absolutely. And in the long term, hydrogen will emerge as a global, competitive, tradable commodity. And that's the natural course that it should take if everything goes as planned. But the difference with LNG, I would say, is that you will be seeing much more supply hubs than you see with natural gas or LNG. So the competition will be fiercer for hydrogen, which is good for the consumer because it will drive prices even lower.
Sohail, again, one a very detailed question on your hydrogen cost analysis. Is there a reason for considering liquefied H2 in the case of North Africa, given that you assumed ammonia exports for GCC? And do you see the figures account for reconversion costs after reaching destination?
Interesting questions. Yeah. Usually for long distances, so if you're looking at more than 1,000, 1,500 kilometers in maritime shipping, we usually ammonia shipments become much more efficient because in the shipment, the liquefied hydrogen experiences losses and some volume will be lost, maybe 0.5 to 1%, but it will be material if huge shipments are being transported. For lower distances, liquefied hydrogen is a business case, makes a business case. But again, not only liquefied hydrogen, North Africa has an advantage of connecting to Europe via pipelines, either retrofitting the existing natural gas pipelines to be able to carry hydrogen, because hydrogen is a very corrosive molecule, or even mixing now to a certain percentage with natural gas and exporting to Europe. So yeah, there is a technical reason behind that. And the other question, which was, actually,
do you account for reconversion costs at destination?
Yeah, definitely. So it includes the production cost, conversion, storage, transportation, reconversion for use. However, in Southeast Asia, in Japan and South Korea, they might be using blue ammonia, for example, in co-firing with coal power plants. So they do not have to reconvert. They do not have to crack the ammonia molecule and to extract blue hydrogen again. So it depends on the end user, but in our analysis, we assumed we added the cost for reconverting blue ammonia back to blue hydrogen molecule.
Okay, the last question relates to energy efficiency policies. What energy efficiency policies have been implemented across the region? Actually, energy efficiency is one key target in terms of energy transition streams in the region. We are taking, or the region has been taking the difficult strides in terms of new renewable projects, new clean energy capacity in generation, grid modernization. However, energy efficiency remains one of the very lucrative and easily achievable targets. Policies, yes, there have been policies that are into effect, and there are new policies emerging every day. Let me give you examples. In 2016, in Egypt, before the power generation surplus, the government set up a policy to replace all conventional light bulbs with LED bulbs. And I remember the public dismay and laughter at this initiative or policy. But in the end, they realized that the numbers add up. And when you have a population of 100+ million inhabitants, each light bulb makes a difference. Also, the manufacturing of air conditioners. Now you cannot set, so as per the standards in Egypt, and I'm not sure about the Gulf, but you cannot go below a certain temperature. So the minimum temperature for setting or for designing and manufacturing air conditioners has been increased. So you cannot leave the AC working towards an unrealistic low temperature. And when you aggregate this on a mass scale, you end up actually consuming much more power than you should. There are also policies on single-use plastic in packaging, especially in retail. Saudi Arabia, through the standardization organization, SASO, has set up targets for banning or phasing out single-use plastic by 2025 or 2026, if I'm not mistaken. Dubai government has also its target to ban single-use plastic in retail sector by 2024. And so on. So especially on the plastics side of things, which feed into the energy consumption per capita on a macro scale, there have been strides for buildings and lighting. There have been strides in Egypt. This is what I'm sure of. I'm not sure about the other countries, but it's interesting, and it can be one of the topics that we dedicate for next year's outlook, Suhail. Energy efficiency.
Definitely. And if I may add also, Rami, to the part about energy efficiency, is that basically having subsidies and subsidizing the fuel and the electricity tariffs in the region usually doesn't drive energy efficiency policies. Basically, you have to lift all subsidies in order to reduce power consumption and make it much more efficient. So I think that in addition to the market factor, there is a very important policy and regulatory factor that should play in to drive energy efficiency policies. For now, the mostly spoken of energy targets are renewable energy targets in the region towards reaching net zero targets. But of course, in addition to energy efficiency, in our paper on energy storage, we also said that we need to have targets on energy storage in order to drive the installation of renewables. So it's a very interesting question, yeah, and I would say that this is totally uncovered in the region, and we should tackle it sometime soon.
Okay, thank you, Thank you, everyone, very much, and thanks for the people who submitted questions. And looking forward to hosting you in future webinars. Thank you.
Thank you.